Morning, everyone. Thank you very much for joining me. Sorry I'm late this morning. My system's actually doing an update, so I had to switch laptops. I'm just dealing with sort of a personal loss, so a little bit erratic this week. So my humblest apologies, and I can't guarantee that it won't be erratic for the rest of the week, but please be patient with me. So welcome to the morning market review. Today is Wednesday, it's the 14th of September 2022. And my name is Russell, I'm a senior market specialist at FXCM, and my email address is r@fxcm.com. And I'm just bringing up the high risk investment warning. I'll keep this on screen for a few moments. And here's our market commentaries disclaimer. All right, references, FXCM MarketScope 2.0, Bloomberg.com, TradingView.com. And hi, Anna, Chris, thanks very much. Hi, Sam. All right, let's go through to the screen here. This is the US dollar. Sorry, again, this is not my my normal laptop, so just bear with me for a moment. All right, let's get the weekly up here. All right, let's get rid of this guy. And let's put in our real rates. All right, this will make things a little clearer for us. One more change here. We'll just leave it as this. It's fine. All right, so take a look what's happening here. We've got the US dollar in the top, and we've got the real rates underneath. And let's throw in a correlation coefficient. All right, let's just make sure that we're looking at the real rates. Okay. All right, here we go. And you can see that the correlation here is very strong. Okay, and this is important because whatever is driving real rates, well, that's going to have a strong correlation with the greenback. And if it has a strong correlation with the greenback, well, we can start making some inferences, right? And what happened yesterday was, of course, the inflation numbers came in really high. And if we could now break this down, so we're looking at a weekly. We go down to a daily. Keep your eye on the middle chart. Okay, here is the candlestick for the real rate. Dollar jumps. Let's go down to a 4-hour. We're not getting the real rates. All right. We'll just go to the daily. And keep a look at the correlation coefficients. The correlation coefficients is strong. So the fact of the matter is, we've got to try and figure out what's going on with inflation, because if inflation is going to carry on being as strong as it is, well then it's probably going to filter through to the real rate. And if it's filtered through to the real rate, then, well, guess what? The dips here, are compelling, right? That's what we said, the dips compelling in an uptrend. Always looking for those dips. Always looking for those dips. Okay, so now let's take a look at inflation. So we'll take a look at it on the core side. Okay, so we'll just take the year on year. All right, so we're taking a look at the core inflation on a year-on-year basis, and take a look at the real rates. As it starts picking up, real rates start picking up, and you're starting to get this part of positive correlation coefficient as well. And the question that we've got to ask ourselves, well, how long is this going to how long is this core inflation rate going to be moving up? And on the core side, there was really, I think, a few things that drove it. Second-hand car vehicles, I think, but I'm not too concerned about that. It's more shelter, it's more your rent, it's your housing that's really driving the core. And the issue with that now is what we call sticky inflation. So we can adjust this, and we're going to bring in something here called median inflation. All right, let's throw in the correlation coefficient here. All right, and you can just see the correlation, the strength of the correlation between core and put the wrong one here. Hold on one sec. There we go. All right, so you can see what's happening is the median. There's no sign of moderation in the median, right? And that's the issue. What are we saying here? All right, so the median is in the middle of a number series. So if you've got a series of 1, 2, and 10, okay, 1, 2, and 10. And if I had to ask you guys, well, what's the average of 1, 2, and 10? So it will be 1 plus 2 is 3 plus 10 is 13, right? Divided by 3. So we get to somewhere between 4 and 5, right? But if you take the median, okay, 1, 2, and 10, median slipping in the middle is 2. Okay, so you've got 2 versus 4 and 5. In other words, the median is not influenced by outliers. It's not influenced by that 10. So if it's not influenced by the outliers, it's showing you kind of where we're running in terms of normalized inflation items. We're not being influenced by the outliers to the top. We're not being influenced by the outliers to the bottom. That's showing no moderation. So if there's going to be some sort of inflation control, well, it's going to hit the sensitive items first. And if it's hitting the sensitive items first, but it's not hitting the sticky items, all right, well, that's why we get kind of getting this 6.3%. Until we get some sort of moderation in the median number, the Fed is going to have a tough job in front of it. And if it's going to have a tough job in front of it, well, then we can carry on looking at the real rate. And if we carry on looking at the real rate, well, it's in uptrend. And if it's in uptrend, it's supportive of greenback. And if it's supportive of greenback, that says a lot in terms of our positioning as traders. Do the Fed look at the median? Yeah, absolutely. So this is actually this is calculated from the Cleveland Federal Reserve Bank. So they tend to look at what's called PCE, right? PCE is your personal consumption expenditure. But the Fed will understand that your PCE is going to adjust as far as your median items let it, Sam, right? So if you, that's why they're so aggressive, is that they understand that the low-hanging fruit, okay, your basic items that are affected in terms of higher rates, okay, so those are going to be influenced first, but then they're going to have a hard time with the median items. So example, we're looking to get to 2%, right? We're looking to get to 2%. We're sitting now at 6.3 on a core. On a PCE basis, we're probably around 4.7 or so. You can probably get 1%, maybe 1.5%, maybe close to sort of 1.75% for your low-hanging fruit, right? But that's still not target. Target's your average of 2%. Well, that's going to be heavily influenced by median. So you kind of want to see your median starting to roll over. Want to see that once we get that median starting to roll over, then we probably see a change in tone in the communication that we get from the Fed. So this is just kind of to lay the platform, is that we're in this heavily hawkish period that's supporting real rates. Real rates, well, that's supporting dollar. But if that's supporting dollar, then it is very much acting as a headwind against euro, against Aussie, against pound, and of course against cryptos. And with that, we'll conclude here, and we'll go through to the crypto webinar, and we'll start looking at how the cryptos were affected once we saw that sticky inflation coming through. Right, so I'm going to conclude here. Please join me in the crypto webinar in the next minute or two. Sam's just asking for the link for cryptos. Bear with me, Sam. All right, I've just putting the link in the chat. Okay, so I'll just wait a few seconds. If anybody wants to click on that link, you can go ahead and click on it now. Just wait another 5 seconds, and then I'm going to conclude. All right, I'll see you guys on the next webinar.